The DeFi market value went from $26 billion locked up at the beginning of this year all the way to $113 billion this November. And the huge surge in popularity is due to the large amount of investors that are interested in these DeFi projects that are offering huge returns. And some of these products are even offering 200 to 300% returns, and a very popular one is liquidity mining. And in this video, we're going to talk about exactly what liquidity mining is, how it works, and how you can start earning passive crypto. But before we start, Alfacash is a great platform where you can buy, sell, and exchange all cryptocurrencies, digital assets, and other blockchain tokens, so be sure to hit the link in the description below and start trading today. Also, be sure to check out the Alfacash Store, where you can swap many of the most popular cryptocurrencies for the euro. And also Alfacoins, which is the best way to start accepting Bitcoin and other cryptocurrencies as payment, both for business and personal use. All the links to these are in the description below. Now, let's get started. Promised returns for liquidity providers and many of these different market makers is very enticing. However, before you get started, you definitely want to do some more research, not only on the individual market maker, but also just on the space overall. That way you can truly understand what the risk and the rewards are. So for starters, let's talk about liquidity mining. Now, liquidity mining consists of staking or lending crypto assets to generate investment returns. So basically, it's like locking up your crypto for a certain amount of time and then receiving rewards for doing so. So basically, in liquidity mining, liquidity providers are incentivized to lock up a certain amount of their assets into a smart contract, and then in exchange they're given economic benefits. And the main purpose of this is to make sure that the pool always has enough funds to run successfully. Okay, so to make this easier, let's go over an example. So let's say you wanted to provide liquidity to a pool with the pair ETH and DAI. So let's say you wanted to provide $1,000 worth of liquidity. What you would do is you would provide $500 worth of ETH and then $500 worth of DAI. Then, as a reward for providing this liquidity, all the fees from the transactions are then collected and distributed to all the liquidity providers, and this is where you see that APY or that return percentage. And DeFi platforms use this mechanism to make sure that there's always enough liquidity for the platform to run. However, the higher amount of liquidity providers that are giving to the pool and the lower number of transactions, this would ultimately result in a lower total activity with this, so then that would give you a lower APY. So obviously the best thing to do is either go into a pool where there is less liquidity providers so you get a higher percentage, or also go into one where there is much more activity daily in the pool. That way you can earn a higher APY. That's why usually the most common liquidity providers you see are on a lot of these very popular decentralized exchanges, because there's obviously the most traffic going through them, so you have the higher chances of better returns. Now, of course, with any investment, there are some definite risks, and one of the main risks to talk about with liquidity mining is definitely impermanent loss. This means that the tokens that you have locked in the pool may actually lose value while they're still locked in there. And depending on when you actually move those tokens out of the pool, this may result in impermanent loss. So an example of impermanent loss, if we're going back to the past example that we had, if we're planning on providing liquidity with an ETH DAI pair, obviously a DAI is the stable coin, so it always kind of stays the same value. However, with ETH, it is obviously much more volatile. So with this, if you were to lock it up for a certain amount of time, and then say the price of ETH goes down while it's actually locked up in there, then that could result in some impermanent loss, because then there's no longer the same amount of value of ETH that you originally provided. So what the smart contract would have to do is that it would have to sell more of the DAI in order to maintain that 50-50 balance. And obviously this is one of the key problems that happens with impermanent loss. This is just to ensure that there's the same amount of liquidity of the pairing within the pool. And now another risk for liquidity providers is actually project credibility. With DeFi being such a new space, and obviously it's growing very rapidly, this means that while some projects are very good, there's going to be a lot of projects that are not so good. So this could be from a problem with their governance, some of their scalability, or even just problems with the smart contracts themselves. You have to be wary about whether these DeFi projects are actually credible. So whether doing your own research or seeing how long and how successful they've been in the past, or even just making sure that the project as a whole is not a rug pull and just the founders are going to run away with the money. You always need to be skeptical and also a little bit weary when you're going into a new project to make sure that you know exactly what you're getting into. That's why it's always important to do your own research, and even doing things such as reading their white papers, looking at their roadmap, their tokenomics, understanding exactly what's going on in the project so that you can be fully confident that you know where the funds are going, what it's being used for, and the roadmap that the project is going to take moving forward. And also kind of going with this is code vulnerability. Like I said, because this is a new technology, there's a lot of projects that are trying their best to try new things or just to get their project out there quickly. And with this, sometimes the projects aren't developed as efficiently as they could be, or there may just be some bugs in the system. That's why there's a lot riding on these smart contracts to ensure that they are secure, that there's no bugs and there's no kind of loopholes within the smart contracts where there could be a hack in there. One way to kind of ensure these smart contracts is to see if they've had audits being done. The audits basically just kind of test out the smart contracts, make sure everything looks good. And while the audits aren't necessarily 100% certain that everything is going to be okay, obviously there are still ways for projects to be hacked, but this just kind of adds a little bit more of a layer of credibility. And now if you're looking to get started in some of these liquidity pools, the main ones that you can start looking out for that are pretty easy to get started, Uniswap, which is the main DEX or decentralized exchange on Ethereum. There's also PancakeSwap, which is the main DEX on Binance Smart Chain, and then also QuickSwap, which is on Polygon. And of course, there are many other ways to start providing liquidity, which is why we definitely suggest that you do your own research and look into some of these other projects to see which ones make the most sense for you moving forward. And now if this video was helpful, go ahead and hit that like button and subscribe to the channel. And to keep up even more with the crypto space, you can check out our blog at blog.alpha.cash. See you next time.